लेकर नहीं बोल नहीं कुछ आया तो अभी
Okay. Um, Good evening, everyone, and thank you for joining in on this webinar on Fincare. So it's been a while since we've done a webinar in the last couple of months. In our previous versions, we've covered companies like Hexaware, Reliance Retail, Boat, Bira, so on and so forth, and we've received a lot of love from our investors and our viewers on the webinars which we have conducted in the past. Today we bring to you a very interesting opportunity, but before we get into that opportunity, I wanted to speak about how the last 6 months have been. So I think the last 6 months, while it has been challenging for tech stocks, have been excellent for the IPO markets. So we have seen more IPOs come in than maybe possibly ever in the past, and we've seen possibly the highest amount of collections to happen in the last 4 or 5 IPOs than possibly would have happened in the last decade. Along with a part of these IPOs were two companies, very recent companies, which were earlier in the unlisted stables, and we've been a very early investor into such companies. One such company was Tata Tech, which I'm sure a lot of you would have been invested into, or if not in the pre-IPO space, you might have invested as a part of the IPO. So Tata Tech was obviously Tata's IPO after 19 long years in the market, and it is basically the ER&D arm of the Tata Group. Basically, it develops the softwares which are used in the automotive segment. Their largest clients being Tata Motors, VinFast, and other large automotive companies. Tata Motors was first identified by our team somewhere around 2014 and 2015, at which point the scale of the company was much smaller than what it is today. And at that point of time, I think we first entered the script at somewhere around 13 rupees a share. And since then, we've seen the price and the company grow steadily over the last 7-8 years, from 13 to maybe around 50, around that. This was around 2016, 2017. 2018 from 50 it went up to 200, 2019, 2020 it went from 2 to 400, 2020 it went from 400 to around 600, 650 levels. 2021 saw another jump from 650 to 800, 850 levels. And then, as a lot of you might have seen, the IPO came at a whooping 1350 rupees, which is beyond our wildest imaginations. And someone who might have invested a little early on might have made a multiple of anywhere from 10x to 100x basis when he would have entered the investment. And I think the critical things which we noted as a part of this wealth creation journey was a lot depends upon the investor's patience level, right? So while identifying a script or identifying a good investment opportunity is a very crucial part of your investing journey, but being able to stand the various cycles of the market and to be able to remain invested till the IPO actually comes out is where you really make the bulk of your returns. And fortunately, a lot of investors who had invested very early on had the patience to sort of stay invested, and I'm sure that Tata Tech has given them their money's worth for their patience. Now that we've covered a little about how the year has been and just a summary on Tata Tech, I would like to bring to you today's coverage. So today we are bringing to you a unique company called Fincare Small Finance Bank. Fincare is basically a small finance bank which is slightly different than most of the banks which we regularly see. So like HDFC or ICICI or Axis, these are essentially called universal banks or full-fledged banks. Fincare, on the other hand, is something which is categorized by RBI as a small finance bank. These specific categories of banks was essentially launched by RBI or approved by RBI with lower capital requirements, lower regulatory requirements to improve the financial inclusion and the depth of financial services in rural parts. And which is why small finance banks, while they had most of the options available as is to a normal bank, they had to do a significant portion of their lending, which is categorized as PSL or priority sector lending, into the rural markets. Right, so 75% of a small finance bank's loans must be originated from PSLs or priority sector lending areas. And in the last decade or so, you would have seen a lot of small finance banks come up, the likes of Utkarsh, the likes of Ujjivan, the likes of AU Small Finance Bank, which is going to be covered at the V end of our presentation as well. So Fincare, I think, started somewhere around 1995 in its earlier avatar as Disha Microfinance NBFC. And since then, it has slowly and steadily grown its base. It started off basically like a microfinance institution. Microfinance is basically lending into smaller chunks to a large population in very small ticket sizes. And slowly and steadily, as their book grew, as their overall investments grew, they slowly and steadily applied for a small finance bank license, which they got somewhere around 2016, 2017. And this is when they sort of renamed from Disha Microfinance to Fincare Small Finance Bank. Since then, the bank has grown its book very, very sharply. So, right from I think a book of around 1,000 crores about 6 years back, it is currently standing at a loan book of about 10,000 crores. It is generating it is on an annual PAT run rate of almost 400 crores. It is having, I think, 32 million active customers on its platform. So, this happens to be a small summary of what Fincare is and what Fincare does. Today we have a very special guest with us, Mr. Prakash Sundaram, and we'll just be taking him live and then doing the introductions. So folks, just give us a second. He's just joining on this call. Hi Prakash ji, very good evening to you. How are you doing, sir?
So good evening. Thank you, Abhishek.
Okay.
You'll have to mute.
I have muted. I think it's OBS mic. Can you mute from OBS? Then I'll just play here and.
Sir, am I audible to you?
Yes, you're audible.
Perfect. So, sir, I'll just get started. Sorry, you're not audible.
You're on mute.
Yeah. Just give me 1 second, sir. क्या करना पड़ेगा उनका आपको आपके लैपटॉप से मेरा भी वॉइस आ रहा है तो आपको स्पीकर तभी ऑन करना है जब वो बोलेंगे समझ गए आप पहले ऑन कर दे रहे हो जब मैं बोलना बंद करूं तब स्पीकर ऑन करो गॉट इट क्लियर तो मैं यहाँ से म्यूट भी कर दूंगा मैं
हाँ,
म्यूट कर
right.
दूंगा तो आपके उसमें मेरा आवाज़ नहीं जाएगा
नहीं जाएगा।
या यहाँ से उनका जो बैकग्राउंड जा रहा है वो नहीं जाएगा.
Okay.
तो मेरे को म्यूट करना है, आपको स्पीकर ऑन करना है. क्लियर?
Right.
ठीक है. Sir, am I audible to you now?
Send आपको देख रहा हूँ.
Sir, is it audible to you?
Yes, yes, I can hear you.
Perfect. So, sir, I just wanted to get started. So, I've just had a chance to give a small introduction on Fincare. But broadly, in terms of getting a better understanding on what Fincare is, what Fincare does, I just wanted to start off with that introduction. But before we get on to that, I just wanted to introduce you to the audience as well. So, Prakash sir has been in the banking space, in the microfinance space, in the overall small finance bank space for over 26 years. I think he has a very deep experience in this space. With Fincare, he was a chief strategy officer till the bank until very recently. So, sir, if you would just want to add something to that, please.
Sure. No, so I have been part of the entire Fincare journey from 2010, largely when the whole team came together. So I've been there from the origin. And I did leave the bank in 2021. So that's been my journey. I mean, I've been involved right through the entire journey of as an NBFC, as a bank, right from the license application to getting the license. I led the entire transformation. So fairly well evolved in the Fincare ecosystem. So that's a bit of background about myself. So I mean, we can go as you deem, Abhishek, from here.
Perfect. Sir, so I just wanted to get started with a small introduction on Fincare. You know, a lot of the audience does not understand why there is a need for a separate category of banks, which is called the small finance bank. What exactly is microfinance? So if you could just touch upon why there is a need for SFBs in India.
So absolutely. So, I think a lot of this actually goes back to, let me say, when Mr. Raghuram Rajan was the governor. And before the introduction of, I would say, before multiple banks came in India, the last bank, which used to be a long time back, was Kotak, which got converted from a NBFC to a bank. I mean, that was one of, I think, somewhere in the 90s and early 2000s. After that, there were no new banks which came into the ecosystem. Now, in parallel, something had been happening in the country, which was, banks were always under pressure to typically lend to what I would call marginalized, even the UN had sustainable development goals. Financial inclusion was one of the top priorities. So there was always one conventional banks to do what is called priority sector lending. It's not actually priority sector. Most people mistake it as only agri or rural. It's a whole pool of things. It's agri, rural, MSME, exports, housing, affordable housing. So there's a whole basket of things. But which is why most banks, if you go back to historically, most banks preferred corporate lending. I mean, retail initially was there, and it was very structured. It was very structured lending to those who have an income tax return, salary slip based. I mean, informal lending didn't really exist. Now, a new set of people, I would call them as microfinance institutions and a set of NBFCs. To be honest, the likes of AU, there are a few more who are playing in that market, who consciously decided to go after a particular segment over, let's take the early 2000s, including a lot of microfinance companies who said, this is our target segment and we don't need a pressure from a regulator, and this is our business model to go, these are valuable customers, we will go lend to them in an ethical way. We will not do, if you see all old Hindi movies of a money lender, we would fight the money lender. That's the history on which it came. And that's how a lot of MFIs came. There was a different model which came in Bangladesh. Professor Yunus started it called, Grameen model. I mean, it's evolved. In India, we had different models. And we said this will not be done on a pressure basis. No one has to push. So that became a very conscious business model. Now, as a precursor to actually small finance bank, I think during the time of Raghuram Rajan, they decided to do one of the most interesting experiences in banking history. They decided to give two banks licenses, two lenders, NBFCs, licenses to become bank. And they were really extreme. One lender was an infrastructure company, IDFC, where the average ticket size of a borrower was 500 crores because they are laying roads. Their customers were people doing infrastructure. So one customer had a 500 crore ticket size or a loan size. The other was Bandhan, where the average ticket size of a customer was 25,000, right? So look at this, they gave license to both of them, which are completely opposite. One is top end, corporate, 500 crores ticket size per customer, one is 25,000. And what they saw is both of those institutions nicely transformed into a bank without too many challenges, and it worked, right? Both had their own unique problems because one was only lending to the poor. I mean, how does it build a liability franchise? And the other was only doing lending, and it had to keep doing lot of different styles of borrowing, long-term paper, etc. So with that success coming through, there was a view that, look, maybe more banks are needed in the country which address these segments. So they opened out licenses for small finance banks. The core difference, if you look, there are broadly only three differences between a small finance bank and any other bank which is called a universal bank. There are only three differences. The first difference is that target-wise, normal universal banks would have typically got a target of 40% which they have to do as PSL lending. A small finance bank, because it's in its DNA, is supposed to do 75%. Now, I'll just clarify, it's a technical thing. The 75% is not on a running AUM, it's on the previous March asset book. So
right.
Whatever, so if you started at 100 rupees closing in March, you have to do 75 rupees. Obviously, institutions which grow, this year suppose it grows by 30, so it's not on a continuous that you need to maintain 75, it's on something called A and BC. But that's a little technical. So that's the second difference which they said is, look, 50% of your loan book must be for loans less than 25 lakhs, right? They should not be, because they didn't want to introduce another segment of customers who are doing, again, corporate lending, going and writing 5 crore, 10 crore, 20 crore. They said 50% could be like that because you are a bank at the end of the day, because today you could have, what is called in the SME definition, a medium-sized enterprise may need 5 crores. I mean, let's be it's not a large corporate 5 crores, small factories, etc. But broadly they said, but 50% of your book should be less than 25 lakhs. The third is broadly, I would put it under capital adequacy as a category. And then there are some other minor points which are minor differences. Basically, the capital adequacy for a small finance bank was set at 15%, while for universal banks, it's at about 8%, broadly speaking. These are the three key differences. There are some other minor differences, like you cannot go open foreign branches, or for example, you will not be an authorized dealer 1, you will be an authorized dealer 2, which means you can't go do forex trading on your own, which anyway, most of these SFBs or these people, that was not the ambition on which they were built at the time when we were all starting out. So very objective, and 72 applicants came actually for the small finance bank licensing. This is December. It was opened out in December 2014. Around end of January was when the licensing applications were all closed. There were 72 applicants, and on September 5th, 2015, 10 institutions got the license. Interestingly, 8 of them were MFIs. 8 of these 10 applicants were MFIs. One was what was called a very old framework called a local area bank. It's called Capital Local Area Bank, which existed from 1999 odd. But they were the only few surviving local area banks, because there were only 3 and only one survived, which was Capital, and it was just hanging around. And then the other was AU financiers, as they used to be called. It was, though AU stands for gold, they were not a gold lending company, they were largely a vehicle finance lender, and they've been around from late 90s. So these were the institutions who got the license. The rest were 8 largely microfinance institutions, because by nature the DNA was to lend at the segment. So this is how most of the institutions between, let's take sometime in, the earliest, if I remember, was Capital, because they converted quickly, and then Equitas was next in September 2016, and within a matter of 1 year, everybody converted into a bank. And I would give you, just to bring some context to this, most of them at that point of time, and I'll tell you, there were basically three institutions who had to convert, and that's why this is very important from today's conversation. I would put it under, there were basically about 3-4 structures around on which people converted. There was a requirement to have a promoter to convert into a bank. Now, and the promoter was to hold a minimum of 26, broadly about 40% roughly, in the bank. And most of these institutions were very, NBFCs get diluted, and people who are original founders end up having very small decimal percentages, single percentages. So when the licensing regime came out, I mean, you don't have such a substantial promoter at that point of time. So except for three institutions, which is AU Small Finance, AU, Capital SFB, and Suryodaya, all of whom where the promoters had the ability to have the 26% shareholding, which was, so they were able to move forward where the old promoters could continue. In the case of the others, effectively speaking, including Equitas and Fincare and Jana, I mean, we are a little different, but broadly even similar. Most of the others actually ended up having what I would call a corporate holding company, and people refer to it actually as holding company very colloquially. This is technically in the RBI world a promoter company and the bank itself. And largely because that's all existed, most of the institutions started with a 100% bank owned by the promoter company, so that there is complete alignment, and they didn't want misalignment, because whenever you have two different shareholding, you will have misalignment, right? So it was most of them started. All the banks, including Fincare, there is a Jana, there is an Equitas, there is a Ujjivan, etc. So everyone started with a situation of a promoter company and a bank, at which time, and I'm going to sometime in 2016, before Ujjivan and Equitas converted, they got their holding company or their promoter company listed, which is what is called Equitas Holdings or Ujjivan Financial Services. That company was listed as part of the capital raise to become a bank itself. So this is broadly, I'm giving an introduction to a lot of people. Then you will have companies like Utkarsh Core Invest, which is the holding company or promoter company of Utkarsh. Equitas has another, ESAF has another company. Equitas company has folded up. Ujjivan is on the way of holding up. Fincare has had a company called Fincare Business Services, which basically was the promoter company. Some of us had this existence, and Jana had a Jana Holdings. Jana has a little different structure, but broadly, for simplistically, we'll keep it the same. But they have what is called a 3-layer structure, which is something what Bandhan and IDFC had to have. But broadly, you can treat, most of them had corporate entities as promoters. AU had a very different circumstance where Mr. Sanjay Agarwal was actually the individual promoter and his family largely. And in case Mr. Samra was the promoter and his family members were the promoter of Capital SFB, Mr. Bhaskar Babu and some of his old colleagues, etc., who started Suryodaya, were the promoter of Suryodaya. So this is how they came. RBI loved the framework. There was phenomenal success on this whole model. And RBI came to a point where they said, this was not the case with payment banks who were licensed at the same time. Many of them surrendered their payment banking license. It didn't actually work. So many people, including, Sun Pharma, etc., they all got licenses, they never started, right? But RBI loved the format, and that's one of the reasons they nudged all the cooperative banks to become small finance bank, and that sort of kept, and they brought the same framework of regulation for cooperative bank, which was a copy and paste of small finance bank. Now, when you have PMC issues, etc., then they got together, Bharat Pay, Centrum, and them to create the 11th one, and SVCL, which is basically the other cooperative bank, chose to become a small finance bank. So this is how you have 12 small finance banks in the country today. So broadly, like I told you, many of them started as NBFC MFIs. To be honest, but I would say today, in reality, I don't think most of them are NBFC. Equitas hardly has 15-20% of microfinance. AU, may get some more by virtue of the merger with Fincare. Capital doesn't have it. Including Fincare itself has only 40% is microfinance, 60% is, it is not, see, there's a difference between microfinance and MSME lending. Like I told you, you can give 5 lakh, 10 lakh LAP loans. There's a good listed company, for example, 5-star is a good listed company, which does similar loans. There's a listed company called MAS, these are all listed vehicles, which have similar target segments, and I can go on. You can do affordable housing. So So this is the background on which how it's worked, and I think it sort of worked from that perspective, meeting the objectives which RBI set out them to be. COVID was a big disturbance, otherwise things would have gone in a very different path. Many would have gotten listed in 2020, that window, which was generally the time for most of them to list. But COVID created what, typical stress in the market. On this particular point, and I will want to bring one very interesting perspective, and it's a very important perspective. I would want to add some humor to this. So let's assume, I'm not going to talk about personal capacity, but let's assume, and let's take me and my family. Let's take an example of a 1% shareholder, okay, of the bank or the institution. I'm just taking an example. And during these 3 years of COVID, let's take the bank, Fincare Bank took 1,250 crores of provisions. Okay, so I would tell my wife, we as husband and wife and as people should feel very proud. And she will say, why should you feel proud? I said, look, if the company has provided for 1,250 crores and has given out, etc., etc., it's not been to some corporate guy who took a flight and flew outside the country and went away. It's been genuinely poor people, women, houses. They are not even middle class. They are poor people. They are probably the maids, the farm ladies, etc., who have, due to COVID, due to so many circumstances, not been able to pay back their loans. I mean, we can put a lot of circumstances. And they said, look, as me and you, we should feel very proud. 1% of 1,250 crores is 12.5 crores. Out of our own willingness, we might have never gone and given 12.5 crores in charity. But treat this as charity only, because people who are suffering have received money. We didn't give it to some corporate group and who ran away, etc. So I'm going to say, look, in a larger ecosystem, yes, COVID was very hard, but I go back and think to say, look, if there were provisions, if there were losses, it was good people. So, sometimes people look at, going and lending to a typical universe, participating in the equity people of a normal universal commercial bank. You're financing one guy to buy his 4th car, to buy his Mercedes, some guy to go buy his 4th house, some corporate group to go do the thing. So every shareholder, whoever becomes a shareholder, must always have the sensibility. Look, apart from shares, okay, you are doing second bottom line, which is true about all, the double bottom line is very, very true. If you carry that emotion in you, the way you look at this will be a very different perspective. You will have a better heart, because look, most people who are shareholders today, generally their life goes on, they're survivable, they're capable. So, in this context, I want to introduce this, that, look, never look at these investments purely from P&L. I mean, great, P&L is great, but I can tell you in my life, if such events never happened, I don't think I would have had the confidence to go give out so much money, right? But today, me and my wife can feel proud that, look, we contributed to the Indian, poor. So I'm just bringing a very different perspective. Yes, COVID was a suffering. Lots of people suffered. I myself was hospitalized for 3 weeks. So I'm just bringing that perspective to lots of people who will be listening to this. You're not funding some, flamboyant, big real estate corporate, big corporate, etc. You are supporting the base of the ground of India. That's very, carry that sensitivity. Once you do that, your whole perspective starts changing.
Absolutely, sir. I think you've answered a couple of questions which were already in my lineup. So I think typically a lot of people have asked us, why have small finance banks created a holding structure? Why are they getting listed? How will an investor in a holdco get an exit? So I think you've answered the question very well, saying that this was part of a regulatory requirement, and so that there's alignment with the bank and between the holdco. So could you just throw some light on on the reverse merger which is happening for a couple of these SFBs, and why has it become a little elongated process for this to sort of happen?
So just to bring context to this, look, the requirement of RBI was for first 5 years, the promoter must have a minimum of 40%. This was the requirement, and then it can come down. Then it became, after 12 years, it can become maximum of 26. So it's first 5 years minimum 40. After that, over the next 7 years, it can become maximum 26. In reality, most of these institutions which converted, they didn't have a big promoter. There was no big individual. There was founders. Mr. Vasudevan was the founder. Samit Ghosh was founder. They were all individuals. They were all corporate employees who just came and started this, right? So they were not like some, what I would call large guys. So this need was a regulatory need to create it. The belief was in 5 years' time, you sort of do away, because it's a maximum of 40% after 5 years. So maximum means maximum, you can take it down to zero. Now, which means if you want to take it down to zero, what do you do with the company? Because all that these holding companies do are they hold shares in the bank, right? That's pretty much. Now, unlike some of the other institutions, like your larger banks, which is why one of the reasons why HDFC's merger today has happened is like an ICAI, a Kotak, etc., where the banks would have a lot of other companies, AMCs, asset management, securities companies, insurance companies. SFBs would have no other subsidiary per se. They were designed, the RBI never liked that framework. So SFB would have no other vehicle. And the intention of everybody was to have only a bank. So with that spirit, the intention was to say, fold this up when it's 5 years. 2017 is when, 16, 17 is when most of them converted. If you see, the 5 years was getting completed in that 21, 22. Unfortunately, in 17, no one, forget that. In 2020 January, no one thought there is something called COVID which will happen, right? So a lot of things got disrupted due to COVID. But everybody believed around that 2020 window, 2021, 22 window, we will fold up everything. The path would be a reverse merger path, complete, be compliant, follow to the T everything that RBI requires you to do, and then apply. And which one successful institution, which is Equitas, actually did it. They got it, and if you know, Equitas holding is already folded up. Ujjivan has received all its approvals, everything is done. It's in the process of getting folded up. See, these timings are very important, 5 years. Now, the other institutions which exist technically, like I told you, Surya, so now 5 of them are sorted out, right? Because 3 never had a promoter company, and you're left with then the other 2 Equitas in Ujjivan. Northeast Small Finance Bank, which exists, it's going a different path. It's getting basically merged with a fintech. Its holding company, the bank, and SlicePay are getting merged. So I'll put that in a closure process because they'll all merge together into one company. And they also had a listing requirement much later. So that's over. So broadly, I've covered 6 of them. You're broadly left with 4 more, which is basically ESAB, Utkarsh, Fincare, and Jana. Then that covers, and I'm leaving out Bharat Pay, the Punjab, basically the central bank, and I'm leaving out SPCL. They just came back 2 years back. So from these 4. Now, in the case of all the other 4, Utkarsh is in the process of doing a reverse merger. They've gotten the bank listed. They will ultimately do a reverse merger. These are all well diversified sharing. It's not like one lumpy shareholder. So anyway, and these are largely PE funds, different people. So it will work. ESAF have a different plan, as I understand. They would want to keep the holding company structure, maybe pursue other objectives. But these things are quite fluid. They can evolve as it goes along. But it may go the path of reverse merger or may go the other path. But that's to every institution's plan. Then you're left with Jana. So Jana, once obviously the listing becomes the first priority, and at some point they may either elect to reverse merge or they may choose. You see, some of them may choose, saying that I want to get into an insurance company. I want, like what is happening with Bandhan. If you know today, Bandhan, its holding company, acquired IDFC's AMC company. They have Bandhan Life Insurance. They have Bandhan General Insurance. So the holding company can then pursue all the other things, exactly like what happened with HDFC and HDFC Bank. Right. HDFC was the holding company which pursued everything. So if you have that ambition to do lots of other things, then the holding company keeper one makes some sense. So Jana may pursue that path, ESAF may pursue that path. Broadly, as I understand, most people know Utkarsh and will broadly fold up. Fincare chose to go a very different approach. And so, while we were on the road, we had filed a DRHP, we'd gotten the approval for the DRHP. I think Fincare has always been, I would say, look, we've always been a very different type of, amongst the 10, we've been a different type of a player. We've always believed in 1 + 1 = 11 and not 2. So there has been a different approach we've always taken, and this is something we've always done. So Fincare obviously has taken a different path, subject to regulatory approvals like RBI, like CCI, etc. Fincare is looking to get merged with AU Small Finance Bank. It's two very strong banks coming together. It's not like Northeast had losses, etc. Fincare didn't have losses. Fincare is doing quite well actually on its own. But it's a different methodology or opportunity which Fincare is looking at to come together and sort of become strong. So we are looking at a M&A process to take this to a different scale, different size. And we honestly, I think, and when I say we, I'm not part of Fincare, but I'm speaking on behalf of what I think Fincare generally thinks of. I mean, from having worked there for 10 years, that's how I'm thinking. So it's trying to go the M&A path.
Perfect.
Happy to answer separate. So Fincare's holding company, I mean, there is and AU Small Finance Bank will both, it will merge into AU Small Finance Bank. It's in public domain. There is the conversion ratio. Anyone using a calculator can then find out for every 2,000 shares in bank, you will get 579 shares. It's declared. So you can effectively, anyone who wants to know the price of a Fincare bank share, it's just saying number of shares multiplied by 279, divide by 2,000, multiply by 579, you will get a Fincare effective share price. So that's a calculator, it's a conversion ratio which anyone can do.
Perfect. So, sir, because you've touched upon the merger, I was about to come to it. Now, before we get to the pricing, sir, while you explained that some of them went through an IPO route, could you just throw some light as to what went behind in the decision of not going down the IPO route but going down a merger? While I obviously understand the synergies, but would love to understand your take on the same.
I'll be absolutely honest about it. Now, I'm not privy to this. So firstly, I've not been part of the DRHP or etc. So my view is as much as anyone sitting outside. So you got to consider it like I don't have any privileged information, nothing.
Sure.
I can only do crystal ball gazing. So let's be honest for them. Look, it's about, okay, today broadly Fincare as of September, because it's in public domain, was about a 12,000 crore AUM size, right? Broadly speaking. Now, what's important is that, yes, from a journey of 100% microfinance, you brought it down to 60%. You will keep coming through. But I think there are 3-4 things that, one needs to understand. That look, Fincare as an institution, and it's a phenomenal team. I myself joined in August 2010. So Fincare actually has seen what I would generally call near-death events, okay, on 3 occasions for this journey. August, it was there. In October 2010, AP ordinance came. Okay, Fincare used to have a large exposure. 1/3 of its portfolio used to be in AP. It experienced AP. It survived. Okay, the Fincare as a group, Disha, and there was another company called Future Financial, they went into CDR, came out. Imagine one of the exception cases, right? An institution going to CDR, okay, and then paid every single rupee to every bank, okay, was to the liking of RBI that you paid everything and then we give you a bank license. So that was the credibility. So it stood the AP test. 2016, Fincare was undergoing transformation. We had a license because September 15 it was given. Your March 17 was conversion. November 8th, 2016, demonetization was announced, right? Which had a huge impact because all customers pay in cash. Right? This is a big impact on lots of MFIs. They were all impacted. And this is very substantial. When you don't have cash, we all remember people were in queue. How do people pay, right? Fincare survived that. Very hard phases of survival. There were hits in P&L. I mean, who's denying it? The year, if you look at 17-18, Fincare's P&L was hit, but it survived. Very lot of difficulty it survived it, right? COVID. Actually, 2020 was not very difficult. The first wave, across India, we navigated it. Many of us navigated it. The country didn't suffer as much. It was the unexpected 21 wave, the Delta wave, which took a lot of financial institutions into trouble. Fincare actually had to navigate that over, it took some provisions in 2020. This is all in public domain. Everybody can read the RHP. So some provision in 20, 21, 22, and up to March 23. So 4 years, it kept taking provisions, which was a huge profit engine. If someone goes and totals, like I was saying, maybe 1,200, 1,250 crores of provisions, it's navigated that. Remember, on March 2020, the net worth of Fincare was only 900 crores. you taking 1200 crores provision on a 900 crore. So fundamentally, what does it mean? That, you got to diversify more faster. You got to build and you have to grow more rapidly. So one is this whole microfinance ratio. Two, expand into other products, expand your geography, because you've got to be a successful winner takes it all. We've seen this across and I would call many of these SFBs are startup business models. Food Panda doesn't exist today. The delivery business is a duopoly, right? So let's be honest about it. So it's got to be a winner takes it all. I'm not talking about overall banking. There is a niche in this space. So the stronger you are, the quicker you move forward, and if you can collaborate together and bring true diversity on the table, it makes sense. If you're going, there is no use Ujjivan and Equitas budget. They both do the same thing, or Fincare budget. So if you're not bringing anything else different on the table, there is no use to it.
Absolutely. So sir, here I want to touch upon one point. So if you go through the financials for Fincare, and a lot of people have come back to us with this question, from 22 to 23 to the current run rate, this is a significant jump. 22 was very minimal profits, 23 was almost annualized PAT of 103 crores, and in FY24 they are doing 100 crores PAT a quarter. So what really changed substantially is what a lot of investors get concerned about.
It's very easy for anyone. If they simplistic, and I know at least March 2020, 85 crore provision was taken because there was no need to take it. It was an advance. It's all in document. Advance because by March 24th we had lockdown in this country. So everybody said, look, let's take advance provision. This is going to be a problem. So in 2020. And then if you go total the provision taken for the 3 years, there is nothing which special happened. Events happened long time back. No, total those provisions and just say they are COVID related provisions and they are one-off. Now you add back, you will automatically see the profitability was more than 400 crores. I'm just giving you. So what is in reality happening? Without hitting the net worth, you keep recovering the event through provisioning and through losses. So your profit will be understated. Then when things are normal, your profit comes back to normal. So all that one needs to do is look at PPOP, pre-provisional, this thing. That is actually growing consistently. So that's the real column. Otherwise, event to April, May, June, Delta 21 mein ho gaya. To be honest, that's when all the event is over.
True.
Everyone, then you're seeing how it's taken into the P&L. So in reality, in fact, for the financial year 22-23, actually, if you see up to September, it was a nil profit because again, it's all in public. It was nil profit. This thing. December was a marginal profit. The whole 100 crore profit was in the last quarter of basically 22-23. So Fincare has been running at this 100 crore plus profitability per quarter. And so the right way to look at it is, I'm just saying, suppose people say the day COVID happened, just go take a minus. Then people like Ujjivan did it. I mean, let's be honest. You excessively take provisions at that time, then your ROA will super rocket, right? I mean, because you're just taking a one-time hit. So your ROA can be low. You take the provisions along the journey, or you just take one big lump sum, very large hit, and then you declare superlative ROAs. Because unfortunately, maths mein, you have numerator, denominator. Make the denominator very small, your ROE will skyrocket. So I'm just telling you, so Fincare didn't do that. It was very sensitive to say, we will not declare losses, we will operate it, we will take the losses as they come along. So this 100 crore profit is actually, just go add back provisions, anyone can know it, it's in public domain. You will know this total. So ultimately it's that. So broadly, Fincare has been running at this 100 crore plus profit PAT engine for the first 2 quarters. Again, I'm doing behind the envelope, always last quarter adds up to profit. Every quarter there'll be a plus, so maybe it'll end at 420, 450 crores. For this year, I have no privileged information, but anyone can say, JFM is January, February, March is better than your first quarter because your asset book is growing every quarter. So your income will grow, your expenses. So everybody knows this in financial services. So that's the engine which is running. So broadly, it is a 420, 450 crore engine annually per se for this financial year.
Perfect. Thank you for that, sir. So I think broadly, unless a COVID-like event actually impacts a large portion of Fincare's borrowing list, because I think around 70% of Fincare's loan book is into MFI lending. So is there any other risk which, say, an investor should account while he is, say, sort of evaluating Fincare?
It's about 60%.
So my question was basically, with respect to an MFI book, should people be concerned about sort of investing into a bank which is a very large MFI book?
See, the way it has to be seen, right? So broadly, and now I'm giving you 10, 12 year experience, right? I mean, to take the total provisions and the total this thing, okay? So simplify maths, okay? COVID big event, we are saying absolutely. For the year 2020, you went and declared 100 crore profit, okay? Then come to the next year, you declared 100 crore profit, okay? In 21, 22, you had only 7, 8 crore profit. And 23, 24, you had, 22, 23, you had 100 crore profit. Every year there are profits, which means the businesses are designed to still make profit in spite of these one-time events. You know, this is how one has to look at it. It is designed. What happens is, great years, you would have a 30-35% ROE. Suddenly it comes down to 10-12%. So everybody have to season out. These are long cycle businesses, right? If you are purely 100% microfinance oriented, Equitas, their profit was not even significantly impacted because their percentage of microfinance was very small. So if you're basically operating on a 100% microfinance, this wave you will experience. But like every SFB, Fincare has come down to 60. Everybody is on a path to broadly bring microfinance to sub 50%. I can give you that's broadly the target. Some will come to 20, some will come to 40, somewhere around that. Broadly speaking, then you change this wave down and you're doing reasonably well per se. So I think that's the logic. If you're pure microfinance, there will be those challenges. Again, then there's a whole variation around geography, which part of the country, which ticket. I mean, during COVID, there was a whole problem about lenders in Assam because like AP in Assam, the government decided to write off. So there were nuances which happened, which impacted Bandhan and Northeast, their P&Ls. Bandhan was a bank, right? So, but because there were some larger challenges around Assam. But what I'm trying to say that, so the business model is underwritten for it. Probably, and this is broadly what most of the MFIs and the SFBs have been doing. It's just not that you take you have to take more aggressive provisioning, and that's typically what everybody has been doing, and that gets you home. So so that's why they provide 100% at 180 days and 50% at 90 days. I mean, no other lenders don't provide 50% of the outstanding. See, it's not about the EMI. If a guy doesn't pay 3 EMIs and you provide if that's what home loan companies do, then the whole home loan portfolio in the country will crash. But they take the whole outstanding and provide for it. So it's a provisioning game. And the way I look at it forward, I mean, if I look at an AU circumstance, it's a small, at the end of the day, it's 10-12% is going to be MFI. It's a very small number, which is going to play out. When I look at all players, in Equitas case, it's 15-20%. So largely, these challenges will no longer be challenges for SFBs because everybody is working on a lower microfinance proportion and they are here to stay. So I don't see this disappearing. I mean, the bank book is much larger. I mean, you have IndusInd, you have many banks. So it's not like, this business is going anywhere. It is going to say it is one of the few high margin. Otherwise, you don't have high margin, do very low. What are the margins of, you leave microfinance out. All the other margins are 1.5% net interest margin, right? I mean, so there is how do I call it? There's a play there. I mean, you take a little more provision. It's not like credit cards per se, but there is a value prop everywhere. So it's a working, established business model. Just have to provide for it sufficiently well.
Absolutely, sir. Makes a lot of sense. Sir, thank you for that. Now I just wanted to dig a little deeper into the merger and understand the implications for the shareholders. So I think for the bank, like you said, it's very, very clear. There is a ratio which is out in the public, 579.
Right. One highlight on the bank. Most people assume that there is an NCLT processes when mergers happen. Just to bring everyone on speed, when banks merge, there are only 2 approvals generally. I mean, obviously you need board and shareholders approval, but from an external regulatory approval, you need an RBI approval.
Correct.
and you need what is called Competition Commission approval. That's pretty much it. I mean, banks is not such it's not telecom, right, where you have two big players and they want to merge kind of
Right.
So it's not that, but it's banks are failing. So that's never, you need only RBI approval for a merger. And we have seen, so there's no, it's because when you bring NCLT, which is what you would have seen in many other cases, where an NBFC has to merge. So let's take Equitas holding company with Equitas was a long process because one is an NBFC or a CIC and one. Whereas here, it's just an RBI process. You've seen all the public sector banks merge. You know, Indian Bank with so and so bank. So many banks merged over the past 2 years. It's RBI gives an approval, you're done. Basically, you consolidate yourself. So
Absolutely.
it's a fairly quick and easy process. It's not a 12, 18-month wait process, if you know, which is an NCLT, multiple state, multiple high court processes. That's not involved. It's largely RBI. This is stated by AU in their public declaration that what are the regulatory approval is only RBI approval and largely CCI approval. So at least for clarity, you know, one can say, look, generally, again, most people will go right formally. I mean, nothing is reviewed by RBI till the banks and its shareholders approve it. So once that is returned to RBI, you know, then RBI will evaluate it. It should be a 4, 6, 8 week, 12 week process. That's the kind of time. I mean, RBI is not courts, right? And it's not NCLT, right? So, and again, it's a common regulator for both of them. They have generally will very similar framework, etc. It's not like one weak, one strong, some loss-making institution. So these are generally simplistic thing, but regulator is regulator. They will have their own view to things, but broadly, it's not a long-drawn process, and I think this is fairly public knowledge today. I mean, RBI will be one of I mean, I'm sure no one does this without talking to their regulator,
Absolutely.
at least informally or in some way, but broadly it should work. So, but it's how the regulator reviews everything on paper. But I think that's the only process. I don't see the NCLT process of a long regulatory window happening for the two banks to merge.
Perfect. So I think that gives a clarity on timeline also. So I think typically what even we went through the AU calls, I think typically 3 to 4 months or maybe 5 months at max is typically what is expected for the merger to happen and for the shares for AU to get transferred to the Fincare buyers. Now for Fincare Bank, while the valuation is very clear, 2,000 shares, 579 shares of AU, and that will come to a pricing of somewhere around, I think, 217, 218 at the current AU price of around 750. For the bank's holdco, which is the Fincare Business Services Limited, the calculation is not so straightforward, and even the process is not very clear. Even people who have an idea have only heard of reverse merger being the only way that a holdco has ever given an exit to its investors. So would love to understand your perspective in the sense that how does a holdco give an exit to the investor and sort of how to come to a valuation?
Okay. So first, there is no obliquity. Look, this whole merger came out in public because one is a listed vehicle, right? So whenever a board decides, it has to inform stock exchanges, and that's how it comes out in public domain. So it was not Fincare had an obligation to declare this, but AU, because it's listed,
Right,
put it out in the public domain, and that's why this came out, right? I mean, so largely it's come. Now, as far as the holding company or the promoter company of Fincare Business Services, is there a regulatory need to state how this is going to unwind? There is no regulatory need per se. It is holding less than 10% in the proposed merger, which is what you say. On paper, it can keep continuing to it, but that's not what it's going to do. Economic interest is not driven that way because you have private equity. 19% of all the shareholders of the bank are also shareholders at the holding company level, because that's how the whole thing came about together. You'll find commonality between shareholders across the board, right? So, but there are what I would call answers to this, which are actually available as snippets in the public domain, which, because these are part of what I would call conversations which will happen between larger shareholders. And I have shared something to you, Abhishek, in terms of some of the because it's in YouTube and public domain. I don't know if you have an opportunity of having that video, which was the EU conference call on the Monday after the announcement of the merger. I don't know if you have that with you right now. If you can play that, that may be a little helpful. But basically, there are two calls. One is that, and one is an interview done by the EU team, Mr. Sanjay Agarwal, with CNBC, where he again is not, it is beyond his local standing, but he does share some insights the path that looks clearly going forward, and I would state it, then maybe you can play this. What will happen is post-merger, Fincare Business Services will get shares in Fincare, which has shares in Fincare Bank. It will get shares in AU Small Finance Bank because the shares will just get swapped. So Fincare Business Services, which is an 80% shareholder today, will end up having about 8% of AU. I mean, I'm just doing a simplistic calculation. It will have shares in AU Small Finance Bank. The whole intention of setting up Fincare Business Services was to create the economic value of banking, right? So otherwise, and there is no regulatory obligation for it to keep existing today. So the company can just get unbound. Now, what many people may not be aware of, these are the benefits of, so there was the insolvency and bankruptcy code which got introduced a couple of years ago. Long time back, liquidating companies was a very long drawn 12, 18, 24-month process. But under the new insolvency and bankruptcy code, generally when companies don't have debt, it's a very clear process. They are given only 90 days to close down the company. And in the process of closing down, what the company will do and can do is it can choose to go sell all the assets, convert it to cash and pay, or it can just distribute the assets, because these are generally equity is very easy. It's a divisible. It's not like a one land which has to be cut and divided, right? And if it assume it's so it just distributes the assets to its shareholders and the company gets closed. I mean, again, I've shared some information to you where it typically takes 90 days. So post this M&A exact date, when which is the appointed date is 1st of February. Again, that's a public declared information, which means on 1st of February, the balance sheets become one. I'm just giving you a understanding of what an appointed date is. That is the date when balance sheets become one. Post that, Fincare Business Services can effectively initiate a voluntary closure process, whether they do it in February, March, in that window sometime, and within a 190, you can take around June kind of a window, May, June window, the shares go back to its shareholders. Everybody becomes a shareholder of AU Small Finance Bank. People.
Got it. Perfect.
Right? What happens is what it is called tax substitution. This is again under the Income Tax Act. Your old period of holding and your old cost of gets substituted for your new shares. So technically, when the holdco gets shares of AU, whatever was its cost of holding for the old shares which it owned in Fincare will become the cost for its new AU shares, and the period of holding will be the same. So there is no tax trigger when the merger actually happens for anyone. That's how mergers are kept tax neutral in the country. I mean, we've seen this across the whole country. Everybody have seen so many PSU, so many mergers happen. So this is fairly a very clean process out there. Now come to the second leg of the transaction. When the holdco distributes the shares to its shareholders, typically there is two incidents which happens. Is at that point, what will effectively happen is, for the people generally, the company per se has, when it's distributing the share, there is no tax on the company. It is distributing. There is no capital gains, etc. Okay, which occurs to the company itself per se. The shareholders, for their purposes, it is deemed to be a transfer under tax. So whatever was their cost for their FBSL shares, that is treated as their cost. Whatever is the fair market value of AU shares they are getting, it is treated as a transfer at that particular date. They have full liquidity on that day. They can go sell in the market and realize, because that's how it works, right? So it becomes it's like they have received consideration not in cash, in the form of AU shares. So it is a tax trigger on them. But for them, that becomes a new opening cost for their AU shares, etc. and their period of holding. That all effectively applies in this case. So that's typically the process which will be from a tax point of view. No one can predict. This is next financial year. I don't know what the finance minister does. I only stating current, what is written in income tax broadly, but you understand it. Budget is not yet there, so they can change anything. A tax is anything at any point of time. Yeah. And there is something called, to the extent of dividend, it is treated as dividend, but there is not. So Fincare has not been a very big operating company per se, right? So it's not like it's got huge operating profit, etc. So largely it will be on this basis.
Perfect. So, sir, coming down to the valuation for Fincare Business Services also, Typically, by this merger, 80% of whatever Fincare Small is getting will get transferred to Fincare Business, and obviously they'll be liquidating it. So, typically, sir, how does the valuation for Fincare Business play out in that case for the current shareholders?
So, so there's a simplistic Excel, and broadly I can give you some sense of numbers. Broadly, for the current structure of this, I mean, about 7.3 crore shares is being given by AU for the purpose of this whole transaction, which is about 10% of their revised, 9.9% of their revised equity. Of this, 1 crore shares, just forget it, is being kept because 700 crores is coming in from Fincare. So about 6.3 crores is going to all the existing shareholders. On that, you apply about 80%. I had shared some number with you, but I think it's 5 crores.
Yes.
I'm quoting again from memory. I don't have the Excel number in front of me, but it's about 5.5 odd crore shares. Am I right? Or if you have the Excel in front of you, just confirm to me. But it's about 5.5 odd crore shares.
Absolutely, sir.
How much was it?
It's 5.3.
So roughly. So what is, and so that's the number of shares, 5.3. Today there are 33 crore shares in Fincare Business Services. So all that one has to do is that 5.3 crores multiplied by some 750 rupees, divide by 33 crore shares which are there in Fincare, you will get about between 116 to 120 rupees range. Broadly will be the effective price for a Fincare Business Services share.
Perfect. And sir, the time to realize this would be somewhere like 6 to 8 months is what is expected.
So again, I am not God, first let me, and I am not a person who is driving the process.
Absolutely.
But look, I'm doing what is called, I'm stating what is in public domain, what is known, and what these things should logically take, right? So that's how I'm going to state it. I'm not RBI to say, oh, tomorrow this is that's let me be caveat.
No, absolutely. Yes.
With that caveat stated, guesstimate, right? So typically, if you think merger process is done, let's say it's in the interest of everyone that March 31st, though you have a consolidated P&L, everybody likes March 31st. So let's assume by March 31st, all that process is done, right? By that time, let's assume the liquidation process is initiated maybe 30 days, then you add another, so 30 days of liquidation process, add another 60, so by June 1st, okay, worst case, end of June, you should be broadly done, everybody gets their share, and then they choose what they choose to do with the EU share. Some people will say, I want to sell. See, it's also, okay, broadly in Fincare structure, 90% plus is all very high institutional, private equity, strong, very, very strong funds who've got long life. So there is, and look, so someone who owns 10% of FBSL is going to own 1% because the 100% is going to own only 1% of,
right.
of AU, right? So regular trade happens, right? So honestly, it's not like there's going to be a huge supply of equity which is going to come. And these are private equity, they hold on. They don't even come into retail market. I mean, generally, if someone is 1% deal, well, retail means they're all done through bulk deal transactions.
Correct.
Being very practical. If someone wants to sell 1% of AU, today market cap is 50,000, 500 crore transaction, you will not go in the market and sell like that, right? I mean, it's 500 crore transactions are of a different nature which are done.
Right.
So that's how they get done. So 80-90% of FBSL shareholding is institutional, SIGB, lots of other Kotak, I mean, so many, Motilal Oswal, a lot of private equity players. It's only the rest is hardly 7, 8, 10%. In that also you have a lot of employees, old management team members who are broadly owning 8, 9%. So actually today, if I look at what broadly HNIs and individuals will have less than 1% of Fincare Business Services, which I would say is what the HNIs and retail, etc. will have. But otherwise, everyone is a very chunky holder, to be honest. So technically, then everybody has some people. Now people will have different views, and for example, I can say my personal view, but everyone will have a different view. The go forward is phenomenal, and I'll tell you, the go forward is absolutely phenomenal. I mean, I was not surprised when Morgan Stanley came and said, look, EU price will go to $1,000. So I was not surprised, and there is a lot of math behind it. Happy to share that in case you want me to. But so a lot of shareholders want to discover the best value. I mean, see, a lot of these shareholders are 7, 10, 12-year shareholders. I mean, 99% of the shareholders are like that. So they will, if there is another 30, 40% to be made They will sit and make it. They are not like, they are not in no urgency to exit and lose away 30% of value on the table. So today it's a 750 rupee stock, $1,000. There's clearly a clear 35% stock opportunity. There is it's based science why, there is economics. I can explain the mathematics why that will work out, but that opportunity exists. So people who are looking at a 1-2 year window broadly have another 30-35% upside, the least, which is what I will sense. So I don't see too much of equity coming out per se.
Absolutely. And typically, sir, the process timeline is what a lot of people have been questioning us. Is what typical timeline should they consider? Because first the first step will happen of the merger, the shares coming in, and then obviously the voluntary liquidation starts.
I think let's take February, March. During March, this banks merge. Let's assume, and we have to go. I mean, I can't guess RBI also. You see, so we have to put an estimated plan, right? So okay, let's take February, March 31st. That happens. Then you add a 90-day window, because that is what the law is for a voluntary liquidation. By the time you could get the share, so I'm saying June end tak ho jana chahiye.
Makes sense.
See, in life you can always have 30 days, 40 days, this side, that side. That is, there is something new coming out from China. So these are like, no one can estimate anything in life, right? So that's okay. But I'm just giving you how we are crystal ball gazing on the timeline in a normal, rational path.
Perfect. Sir, this has been really helpful. I think we've had a very good understanding of the overall small finance bank space. You've had a chance to sort of walk us through the origination, the genesis of all of these 12 SFBs, how they started, how they came up. We had a chance to understand how Fincare's journey has been, what makes it different or what sets it apart from the other SFBs, and also a lot of details on the merger. So I think this has been really helpful. Sir, if you have another 5 minutes, maybe we can just take in some questions.
Something. I want. At least the good part is when you're outside, you can share your perspective, right, freely. So I wanted to do 12-month forward, 9-month forward, crystal ball gazing on AU, right, and this what this means from forward, because that's what is the secret sauce which many people may not read out in this whole thing. Look, we all discuss, okay, and this is public domain. AU has made broadly 800 crores in the first 2 quarters up to September this year. I'm saying, okay, you just take it for the whole year, it'll be 1600 crores, add another 100 crores last quarter effect, etc. AUM is growing 1700 crores, 1650 should be the profit for this year. I'm just doing arithmetic, right? But 4 times quarterly profit. Fincare has done about 200 odd crores. Again, last quarter effect, 450 crores. So broadly, this is what you will look at from a profitability engine point of view. But what needs to be looked at a little differently is, Fincare historically is a 30% growth engine. I mean, you can look at that DRHP every year, you will see it's 30%. So on a simplistic math, if I was to go the next year, 24-25, this 450 crore with a 30% growth is a 600 crore, 150 crore is a profit addition potential. So what you need to look at is to say, okay, this year independently AU, let's assume it delivers 1700 crores. Now, on its own strength, assume it's a 20% addition of profit, just nothing else. If AU was everything else, I'm just looking at some past trend, it would go to 2100 crores for 24-25 as profit. But now you're adding 600 crore, which is a Fincare profitability. By that time, Fincare's AUM will be about 15,000 crores. And there is a 1% cost of fund difference, broadly speaking. Again, some of this has been declared in public domain. Cost of fund between both of them has been come out. AU has declared it to stock exchange. A 1% difference on 15,000 crore, where Fincare has a higher cost of fund, AU cost of fund, will translate into 150 crore profit addition, which means the addition of Fincare could lead to 650 plus 150, broadly anytime between 750 to 800 crore of profit addition. So what could be on a standalone basis 1600, 1700 crore profit this year? You're then looking at a 2700, 2800 crore profit next year for AU, right? Now, AU has been operating at a 30 price to earning historically. I'm just throwing some historic numbers. You can go put that multiple 2,800 into 30, takes the market cap to must be 80,000 odd crores. I'm just throwing a number here, 80,000 odd crores number. I've not done a calculator, but I'm giving you some number. The post cap, this 50,000 is the current market cap of AU. You add 5,000 crore because of the Fincare, it should be 55. So 55,000 to 80,000 market cap. If the PEs are the same, you can go around doing the same multiple in terms of book value. So many methods. So then you're looking at 80,000 crore. Then you're looking at $1,000 very easily, if not anything. Because 55,000 crore, 80,000 crore market cap. I mean, you can do the maths, right? So this is the forward. I've not even gone to the story. Every time there's this conversation, what happens when AU becomes a universal bank? If people are listening to it, immediately you're looking at a very different play. That 75% PSL and 40% PSL plays it, which means there is a, basically 35% PSL, which AU can technically sell and create other income on a 1 lakh crore, 1.5 lakh crore, which means I'm saying even 50,000 crore into 2% is what you can earn. You have another 1,000 crores of profits, right? And your capital adequacy, where you have 15% capital adequacy, if it's 8%, which means you can now just double grow your balance sheet without any line. You don't need further capital. Whatever is your capital, right? Your requirement has come down. You will choose to take more capital, but no further dilution, growth, long head, tailwinds to grow. So, so the forward view is phenomenal. I mean, I'm seeing this play out over next year. I'm not talking of, savings of leadership costs, saving of a common IT skill, or others. There are, if you put synergies, there are 50 synergies which will come down. But I'm just talking macro synergies.
Absolutely, sir. I think that makes a lot of sense because the whole Fincare merger is one thing, but what the benefit of the merger will be to a combined entity and how that will play out in the next 12 to 18 months is a whole other ball game. So I think all of the points which you've mentioned, the lowering of the PSL limits, the lowering of the car limits, can actually sort of change fortune for the bank. And if actually they are able to go down the universal banking route, I think AU will become something of a very different avatar than what it is right now. Perfect. So, sir, I would like to at this point sort of just take a larger view on the banking space. So I think while banks have broadly done well in India, and this is the last question for which I'm going to hold you, but banks have broadly done well in India. They've been generating a lot of profits, but over the last couple of months, or a couple of years rather, the average price to book multiple has sort of reduced for banks from what we had seen earlier for it. For example, maybe like HDFC in its earlier 3-4 year earlier time span used to trade at average multiple of 4, 4.2, 4.3. But now that's gotten rationalized to around a 3, 3.3, 3.5 kind of a region. So what are your thoughts on this? Is there something different which is happening in this space?
No. So let me bring. First, let's start with this problem. This is not an India problem. This is a global problem. First, let's start with this as you can go pick up the price to multiples of JP Morgan, Citibank, Bank of America. These are not the stars even in the US markets, right? So first we need to understand that, look, one thing that happens, and I'm saying, so first let's start from there, then you come to the India scenario, because there is a alignment there, right? Whenever most people actually don't realize that, unlike they're all used to FDs, etc. When interest rates go up, okay, generally they say banks do well, but most of the banks world over actually have an asset called securities, which is on their balance sheet, right? And the way securities are priced, when yield goes up, security prices come down, right? So this is a basic of bond economics, right? It's not like an FD. So that's why there are a lot of banks in the US. And in India context, I'll bring it differently. In the US, they say a lot of these banks are having low yielding securities hold to maturity for long times. There was one big bank which failed in the US, which was Silicon Valley Bank, because they just couldn't even manage to pay. So what they bought for 100 rupees as government securities, when the yields go up, the value of the security comes down, so it becomes 80 rupees. So they suffer more, and they couldn't say one bank went down, which is a US bank. So this is the first. Second, when risk-free yields, government security yields go up, price earnings fall. This is again, simple, because risk-free. So this is the price is the earnings. So first there will be a re-rating on price earnings across the world. So that's again a price multiple falls down globally because of. So there are two things playing. One is this whole government security, banking, etc. variable interaction. Second is all price earnings. Now we must understand this contextually. In US situation, it's going from 0 or 1% to 5%. So you can say what securities were 100 rupees have fallen to 20. India, that change, we were at 4, maybe has gone to 6. Again there is a relevance there. Second, so it's not as, it's like 5 times there, it reminds me of a Kotak ad, 4 and 6 kind of thing, but yeah, I'm just saying from there 1 to 5, here probably from 4 we've got to RBI repo rate,
Right.
have got to 6, so I'm just giving you a sense of the magnitude of it, it's not as bad. Second, the economy is doing well, India is not facing a recession kind of variable, that's why Indian institutions have continued to grow. What actually people don't realize, and this is what I keep telling people, and this is a macro understanding that someone has to get. Actually, even at 22,000, I'm talking Nifty, India is very cheap. You know why it is cheap? And I'll state to you why this is cheap. Okay, and this is not because of a reason. Because India has been funneled, whatever has been happening till today is only domestic money. And let me give you 2 reasons why it is cheap. And this, once that plays out, all these banks, everything will get re-rated. I'll tell you why. October 19th, 2021, after COVID is when you had a peak. I think we went to about 19,800. Nifty I'm talking was October 19th, 2021. So let's take FIIs pulled out money in October 19th and they took it out at that time, right? 2021. Over this entire 2 years, and we are about 2 years down the road, they would have earned on government securities about 5%, 10% they would have earned. Okay. So I add 10%, let me take 2 FIIs, one exited India at 19,800 and one chose to be invested in India, right? The guy who took it out, right, got 19,000, he has earned 2,000 points on GSEC earning. Risk-free government security, he has earned 2,000, right? The currency was 75 rupees to a dollar. Today it is 82, 83, which is another 10% broadly, which means he took out the money and kept it, and today if he was to put it back, right, there's another 10% jump. So if I was to simply say someone took out that at October 19, made a 10% on government securities, made 10% cash, so you would have a 20% jump. So from October 19 to today, logically you should have 4,000, which should be 24,000. I mean, that's comparing 2 FIIs who just did nothing. One took out the money and one put it in government security and just had foreign exchange returns. So the guy who held on to the Indian market has not even been rewarded for equity risk, for emerging market risk, all this, because it's been the strong support of, and see, I'll come to the banking answer, and I'm just coming because it's a little long-winded answer.
Sure.
But why I'm saying that is that in realistic world, to compensate the guy who said, I will hold on, the index has to move to 24,000, right? I mean, just for a guy to take equity risk and emerging market risk, well, the other guy went to, government security risk, right? So that now, why has it gone down, or why is it holding on in that range? The Indian flows have been so heavy that they kept selling, taking out money, and the domestics have supported it. When they start coming back in that same pace, ultimately, where will they go by? This is the common thing, right? The market cap of the entire Nifty 50, is smaller than the market cap of Apple. That's the reality. Okay, the market cap of entire 50 is smaller, which means if 10% Apple goes up, then all your Nifty has to go up by 10%. I'm just saying, whatever they put, and I'm not talking the whole US market, right? So it's very small money. The minute that money comes in, then where will they go put the money? They will end up putting it in the top 100, 200, X number of stocks, which will trigger on the bottom. So that has not happened, unfortunately. And the minute that happens, your re-rating happens. I'll give you examples of banks. Now, we can say banks have not done. Ujjivan, July 2022 was 15 rupees. Today it is 60, went to 60 rupees. It was, less than 1 time price to book, went to 3 times price to book. Okay, this is called sentiment in the market. I mean, it was, you can say it was absurd. No, why would it be at 15 bucks? Okay, I can tell you Equitas has got to 100, it fell all the way to 40. So there have been banking stocks which have doubled. So many IDFC, I can go on. Karur Vysya, there are so many banking stocks, have they doubled? Unfortunately, for a HDFC to move, right? ICICI has done reasonably, but for a HDFC to move, the corpus of capital that you need is so large, उसमें इतना swing होता है, then you do need that strong, I mean, it's a 74%, I mean, they were the exception where they went and took a approval for 74% FDI limit, right? So technically, you need real FII funds to start kicking in. It can't just be going on with our mutual funds and our domestic play. The day that happens, boom, then you will say, I missed this this is what will start happening. You know, when they run, I will not be shocked if suddenly HDFC is $2,200, right? So it is re-rating. I mean, look, always, and this is Warren Buffett principle. If the bottom line is improving, if the company is performing, then keep temporary, if you are a long-term investor, look at that. That's the fundamentals of a company. Look, HDFC is just growing phenomenally. Nothing dynamically has changed, right? So it will just get re-rated. It just needs a burst of liquidity to come. Stock come burst. It's a liquidity play. It's skyrocket. This is all that's required. It's get the FIIs to pump in money, and India is still cheap. It will happen.
Absolutely. Perfect, sir. Makes a lot of sense. So, with this question, sir, I would like to thank you for taking the time out, for sort of coming over to our call, for sort of bearing with our basic questions also and answering them in such a lucid manner that even a novice could have understood everything. Fincare is a very interesting opportunity which a lot of investors at Altius have invested in the past and have evaluated from an investing point in the future also. So I think this whole conversation will serve as a very good bedrock for them to sort of get clarifications on how to evaluate the company better. So I would like to thank you again for taking out the time and sort of coming up on the call here for us.
Thank you so much.
Thank you so much, sir.
Some used to some people are always.
Absolutely, sir. Thank you so much.
Bye.
So, I think that was Mr. Prakash Sundaram, who has given us a great overview on what Fincare is and what Fincare does and what that is all about. We've had a chance to discuss right from the company's genesis to the financials, to the merger, to the valuations, coming down to a price level data on what Fincare small finance should be valued at and what Fincare business services should be valued at. Obviously, valuations are subject to personal opinions, but happy to answer any other questions, or you can also write to us or reach out to our teams if required.